Hi everyone. Welcome to Module 6, that quantifying physical and transition risk. And I am Jay Shah for the various climate risk assessment course that we have published through the BTW AI Academy. And this is where we get a genuinely quantitative for the first time in this masterclass of the climate risk assessment. So let's get started. So in the first 5 modules, we have built the conceptual foundations, what climate risk is, how it's governed, what scenario are used to model it. Module 6, where all of that becomes a number on the page that a CFO or credit committee or board or any climate risk analyst can act on. So we are covering 3 interconnected areas. So the key financial metrics used to quantifying climate risk, including the climate value at risk, also the WACI, which is weighted average climate intensity, the hazard exposure vulnerability framework for physical risk quantifications with walked flood modeling example, and the open source tools, and also lots of AI marketplace tools that we have developed and you can utilize in your day-to-day life. That is resource that make this analysis very accessible without expensive proprietary data subscriptions that big data providers are selling right now. So everything in this module is practicized, and in the companion Excel, we will also do the climate risk assessment through the financial modeling in terms of financial assessment. And that workbook also having those kind of formula I have developed for from myself, whatever that face problem in the market, and I developed that climate risk modeling in the Excel so that everyone can understand first that what things is going on, and then utilize the various tools that can be available in the market, which is very expensive. I would not suggest to use those kind of tool. I will share few of the tools that you can utilize if you want to explore the climate risk scenario analysis at company level or any asset level. So open it alongside the sessions if you can, and then you can explore that tools through the website. I will share that in this module only. Thank you. So let's get started. So module 6.1 is about the metric architecture. So we will see the CVAR, expected shortfall, WACI, physical risk score, stranded asset ratio, climate beta. So these are the metrics that usually the financial institutions and as well as the any companies across the various sectors are using to reporting, to do the climate risk assessment, and to do the investors reporting as well. So these are the 6 metrics that you will encounter most frequently in the financial institutions, and by end of this sub module you will be able to explain what each measures and when it should be used. So module 6.2 will goes deep on the physical risk quantification. So specifically the hazard exposure vulnerability framework and the annualized expected loss calculations that can be part of the financial institutions, but it also part of the any kind of manufacturing, retail, marine sector, transportations, energy, wash, any kind of companies that they are doing the climate scenario analysis. So we will walk through a real example, a coastal logistic hub that model under the various scenarios. We will see that. Also, in module 6.3 is your tools and the resource guide. So I will share the open source tools, also the my marketplace that I have built that tool that you can utilize in very cheap price, and the company level climate scenario analysis dashboard that you can use immediately for your client or internal work. So let's start with the module 6.1, the metric framework. So if you have ever been asked to put a number on climate risk and wondered where to start, this section gives you those answers. So first, let's talk about the climate value at risk. That is the core metrics. So CVAR is the primary financial metric for quantifying climate risk. Traditionally, if you have the financial background, it is always there will be the financial value at risk, and they calculated through the traditional formula and the traditional financial credit risk assessment. So this its formula is related to that hazard times exposure times vulnerability, that presented value to today. So basically it covers hazard, exposure, vulnerability, and what will be the present value to today. So let me walk through the each component. First is I mentioned the hazard. So hazard is the physical climate event. Flood depth in meter, for example, that will be the one quantifying metric. Temperature anomaly about the baseline, wind speed, drought, severity. So those kind of hazard is part of the physical climate event, and those kind of quantifications data that we will require to do the quantification of CVAR. So this comes from physical climate models and run under the NGFS or the IPCC scenarios. And the important things to understand is that the scenario become more severe, both the frequency and intensity of hazards event increase. So for example, under SSP 5.5 to 8.5 by 2100, flood events that currently occur once in a century that may occur 2 to 4 times more frequently, and they may be significantly deeper when they do occur. So that is part of the whole hazards related stuff. Now let's comes to the exposure. Exposure is the asset value or revenue stream located in the hazard zone, and this require a geocoding. Why? Because it's require the lat long and other stuff of mapping because of which zone that particular asset located. So mapping your assets physical locations against hazard intensity map, it is very important. So at portfolio level, this is what Climada, Aqueduct, or the OS Climate, which is a open source software, open source climate risk analysis tool through the Python language, help you to do that at scale. So that is exposure related stuffs, and that require a lat long or the asset level details, that where your asset is located and what will be the impact around that particular assets. Then the third one is vulnerability, is the damage ratio basically. So what fraction of the exposed asset value is actually lost when a given hazard event occurs. So this is derived from a depth damage curves for floods, for example, where engineering functions that relates flood depth in centimeters to the fractions of buildings value that's damaged. So these are not guesses, they are empirical calibrated from actual insurance loss data across the thousands of claims. And the fourth component, which is also very much important, that is the present value discount. So future climate losses need to be discounted to today to be comparable with current financial metrics. So for example, MSCI use about 3.5 percentage as the discount rate for the long-term CVAR calculations to 2100. So if you use your company's weighted average or carbon calculations instead of those kind of stuff, which might be 10% or higher, you will be significantly undervalue long-term physical risk. So that's a known methodology tension that practitioners need to navigate transparently, and it depends on you and your company and your enterprise that how that particular present value formula that you are making sure that it's look like a science-based formula. So the formula is in Excel workbook, that module C of the CVAR calculation sheet. I will share as well during our whole module calculations. I would encourage you to change the hazard and discount rate inputs and see how sensitive output you look like for your organizations or for your products. So this is the climate value at risk formula, where hazard intensity, exposure, vulnerability, and the asset value is very much important. And the discount factor, as I mentioned, that it is very important that how you look like for 3.5% to 10% or maybe more than that. And based on that, you will understand what will be the climate value at risk. So this is the formula that big players are using. It depends on which type of quantifications text that they are using, and they will have the different CVAR for same company. So you have to understand that very much quickly, and then you can calculate the CVAR very easily. Now, as I mentioned earlier on the introduction of this model, that climate risk matrix is very important for the financial industry, and that these are the key climate risk matrix that used to used by the financial institution, and which is very important, and I always advise financial institutions that how it can be calculated and how it is very important for your loan portfolio or any kind of sector or company. So this table is your working reference for the 6 metrics you will encounter in practice. So I will go through each and climate var, the core metric we just covered, that expressed in pound million or percentage of portfolio, that used in TCFD strategy disclosures, and now it's also going to be disclosed through the ISSB S2 scenario analysis. So every company has to do those kind of stuff, and based on the jurisdictions as well, there are so many of scenario analysis disclosures they are asking for the CVAR. So expected shortfall is the average loss in the worst tail of scenario beyond the CVAR threshold. So it's a more conservative than the CVAR and is what Bank of England and the ECB use in regulatory climate stress test for the capital adequacy calculations. So expected shortfall, that is ES, which is depends on the various regulatory requirements, laws, and also it is greater than the CVAR as well sometimes. Then WACI, which is weighted average carbon intensity, is the standard portfolio transition risk matrix for investors. So it's a required under SFDR as a principal adverse impact indicator, and the benchmark for Paris alignment is below 100 tons per million of pound of revenue. So that is a wacky, and I have added the formula, also the remarks, and also the primary use cases, that how it's utilized for that. Then it comes the stranded asset ratio is particularly important for the lenders and equity analysts covering high carbon sectors. It tells you what fractions of companies' total asset are at risk of economic write down and under a given scenario. And that is very much important to understand that when your asset is going to be a stranded. For example, in Germany, there is all the coal-based power plant are going to be a stranded asset by 2030, because they are going to shut down all the coal power plant, and for that every company has to do those kind of stuff and make sure that their asset value is still economical viable through the various renewable energy program. So coal is very much high emitted area, and that is why it's going to be a stranded asset. So counter intentions, the stranded asset risk is highest under the orderly scenario, because aggressive policy actions forces rapid retirement of fossil fuel assets, as I mentioned the coal-based power plant example. Then it comes to the physical risk scores, is the normalized 0 to 100 summary of the HEV calculations. That scores about 60 are typically flagged as a material, and that is very important. So mortgage lenders use this to adjust loan to value ratio on flood exposed property. So physical risk score is very much important, and it is very much required through the adaptive capacity hazards and exposures. We will see in much detail that how it quantified. And climate beta measures how sensitive a portfolio or equity is a carbon price changing. So a portfolio with a high positive climate beta will lose value when carbon price spike. So that's the disclosure scenario risk in a nutshell, and which is very much important, that this matrix how it's look like for the financial industries and other industries as well. So let me walk you through the worked transition risk example from the Excel workbook. I will explain in slide first, and then we will walk you through the detailed example when we will have the transition risk and physical risk understanding through the slide. So first let's start with the transition risk. So the company is Acme Energy, which have the 2.5 billion in revenue, 850 kilotons of scope 1 and 2 emissions, EBITDA margin of 22%, and as per the NGFS scenario, under, as I mentioned in other modules, these are the different scenarios. So for under the NGFS, since it is very much relevant to the financial institutions. So under the ordinary scenario, a carbon price of 150 per ton by 2035 is assumed, and based on the data available in the market. combined with 30% abatement produces a carbon cost of 95.6 million per year. That's 70.4 percentage of EBITDA, and significant but manageable with planning time. So these are the scenario, and under the disorderly scenario, which is the carbon price spikes to the 275 per ton. So in that, delayed actions follow by abrupt policy shock, the annual carbon cost going to rise to 176 million, and 32% of EBITDA, that kind of heat to profitability in short time frame is what create a financial disaster distress risk. So this is why disorderly is the scenario that central bank stress tests focus on most. And under the hothouse world, where carbon price are only 20 per ton, where their minimal transitions policy, so the carbon costs are just 30.6 million, and a mere of 2.5% of EBITDA, but that comes at the cost of severe long-term physical damage, which shows up in the physical risk worksheets. So that is very important to understand that how it's look like. So the standard asset calculations tells a different but related story. Under the ordinary scenario, the 45% haircut on high carbon assets produce 2.5 billion of standard asset risk, and the transitions timeline is just 10 years, and giving annual loss is of around 249 pound million for that particular scenario. Under the hothouse world, the haircut is like only uh, uh, 8%, but the timelines is 25 years, and the total physical damage cost, the standard assets are very much things. So the key insight at the bottom of this slide, you can see that the one I really want to land, that the scenario with the highest transition risk is not the most ambitious one. It's the disorderly scenario where the policy fail and then overcorrects. So that mismatch between the expectations and reality is where financial instability risk is highest. So these are the trade-offs and dynamics you have to understand for the transition risk quantifications. So that is why I just gave the example before we go into the quantifications, and you will have some of that idea that how it's look like for the carbon price, annual cost, EBITDA, for orderly, disorderly, or hothouse world scenario. You can also read through the your learning guide materials and also the detailed Excel that we will also look into that. Now we will cover the physical risk quantifications, and after that we will go into the Excel sheet modeling as well. So for now, module 6.2, that physical risk quantification. So we are going to get into the mechanism of how you model flood risk, heat stress, and other physical hazards in financial terms. So this is the technical heart of the module, which is very important for the climate adaptations, resilience, mitigations, transitions everywhere. So it is very much important that how the hazard exposure vulnerability can be calculated. So the hazard exposure vulnerability framework is the universal language of physical risk quantifications. We already seen the CVAR matrix where hazard exposure and vulnerability is the part of that. So the overall major tool, as I mentioned earlier, that open source Python language tool, that is Clamada, Aqueduct, Oasis, the World Bank's GFDRR methodology. Those are the physical vulnerability risk assessment is available for the methodology and framework. So that is use some version of this framework, and let me make each component very concretely to understand why it is very important and what is the meaning of that. So hazard is what nature does. For flood risk, that's the depth of water above ground level at a specific locations under a specific return period event. For heat stress, it's the number of days above a threshold temperature like 35 degrees Celsius across the Europe, and maybe in South Asia more than the 45 degrees Celsius. That hazard data comes from the climate models under the NGFS pathways. The hazard increases as a warming increase, and the climate multiplier for flood hazard can range from 1.4 times the baseline under SSP 1 to 2.6 by 2050 to 4.5 times under the SSP 5 to 8.5 by 2100. So exposure is what you own that's in the hazard zone, and that is very important after the hazard uh, calculations vulnerability assessment that we have. And at the asset level, it's the replacement value of building or piece of infrastructure exposure. So that is very important to understand. Exposure is different at asset level and different at portfolio level. So at the portfolio level, it's the sum of all asset values weighted by their geographical locations in the hazard area. So tool like Climata use LeadPop, a global gridded dataset combining nighttime light and population data as a proxy for economic exposures when company-specific asset maps are not available. Third one is a vulnerability, that is the engineering and empirical science piece. It tells you how much damage a given hazard intensity actually causes to a given type of asset. A shallow flood of 20 centimeters in a warehouse that causes very different damage to the same flood in a office block or a hospital. So depth damage curves encode this relationship. The GRC European depth damage functions and the US HAZOS model are the primary open source for this kind of data things. So when you multiply these three together, you get the risk for any kind of physical risk related stuff that expressed as a expected loss in monetary terms. And when you apply a climate multiplier to the hazard components, you get the climate adjusted risk. So that's exactly what physical risk AEL that consider the sheet name I given in the Excel workbook model. So we will also look into that. So these are the basically the formula of calculation of risk, hazard, exposure, and vulnerability, where how you can calculate the hazards, what is the exposures, and what is the vulnerability importance for calculation of the risk. So now let me walk you through the worked example step by step, similar to the transition risk. So the asset is a coastal logistic hub in Mumbai in India, with a replacement value of 120 million and business interruptions revenue of 1.5 million per day. So the AEL, which is annualized expected loss, works by summing loss across the 6 return period events from 1 in 10-year flood to a 1 in 500-year event. For each return periods, we know the annual probability. A 1 in 10-year event has 10% annual probability, and we know the flood depth at these locations from the hazard maps. So using depth damage curves, we convert flood depth to damage ratio. 0.2 meter flood cause about 12% damage to the asset. That's 14.4 million. So we add business interruptions loss for the days the facilities is shut down. So we deduct insurance coverage at 75% and we multiply it by the annual probability to get the AEL component for that particular return period event for that in 10 years. So summing across all 6 return periods gives a baseline annual uh, expected loss of 5.35 million per year. That's 4.5% of the asset value annually. So every year on average, that is 4.5% through the various scenario. So now apply the climate multiplier under the SSP2 to 4.5 scenario by 2050. That flood events in coastal South Asia occurs 1.8 times more frequently and flood depth increase by factor of 1.25 times. That multiplies the AEL to 9.63 million, nearly double the baseline that we have calculated for the 10 year scenario related stuff. Under SSP 5 to 8.5 by 2050, the multipliers are 2.8 on frequency and 1.5 on depth. That is very much important to understand that how it's look like. So producing an AEL of 16.05 million, three times the baseline. And what does this mean for asset owner? A commercial loan secured against this asset should factor in increasing AEL as a drag on asset value over its life. So an insurer covering this asset is seeing its expected claim increase year on year, and a company operating this facility needs to either invest in flood adaptations and resilience infrastructures or start modeling relocations. So that is very important to understand that how it's connect to the climate science, financial impact assessment, insurance, and also the lenders related activity. So we will see that example in the Excel as well. So I hope you understand this kind of technical stuff through my easy of explanations, and I will also explain in much more details through the Excel as well. So now let's start with the climate risk modeling and financial impact assessment. That example we already shown in the slide. Same example we will see in the Excel sheets how it's look like, so that you can understand more in manner that how this climate risk assessment is very much important for every industries, every financial institutions, every companies that is requirement. Let's start with that. Hello everyone. So now let's start with the climate risk financial modeling workbook, which is climate risk assessment, and which is very important to understand through the Excel, and you will understand lots of stuff that how it's work and how this sheet worked through the climate risk assessment, including the transition risk, including the physical risk assessment. So what this sheet contains, basically the instruction sheet that has no formula. It is just reference sheet only, and it contains workbook title, module, as well that navigation map to all six sheets that we have in this whole uh, things, in including the one line descriptions and also the color guidings that I have mentioned, that essential for learners to understand blue versus black cells and how it's work for the various other cells as well. So basically the learning objectives is how the practice by working through the model. And just to explain the color coding, the blue text on highlight blue background input cells. So you can change these cells by modeling your own company or own scenarios. So basically blue is your data. Black text on white or gray background is like formula cells where automatically calculated, and do not edit. Black is the calculated result. Then violet or indigo, that headers row, where NGFS ordinary scenario column or the sections headers are defined. Amber is header row, again NGFS disorderly scenario column. Red headers having NGFS hot house world scenario column. And then the green teal text, which is key output metrics, financial result, and the material risk flex. So those are the stuff is there, and we will start through this instruction sheet, and then we will move into the various other sheets. So again, welcome for the climate risk financial modeling workbook. Before we touch any numbers, let me show you how this workbook is organized and how to use it. So you are looking at the instruction sheet. The first step I also explained the stuff. This is your reference guide for the whole workbook, and there are six sheets in total. As I mentioned, for instructions, so the most important things to understand the color conventions. Any cell with the blue text, light blue, as I mentioned on that, that will covers everything on the edit data, also the formula data. The column headers use three colors and corresponding to the three NGFS scenario that I've used: violet for orderly, amber for disorderly, and red for hothouse. So let's move to the company profile sheet. And this company profile sheet basically is the single source of the truth of the entire workbook. So every formula in every other sheet pulls it company specific data from this sheet that change a value here, and the CVAR calculator, physical risk, and portfolio sheet all update automatically. So this is a single source of the truth. And the section A, which is a corporate fundamental, mentioned in the blue cell B5 from B5, where it covers all the hard code inputs. You can types them in based on your companies, and you can do your reference company. Here I did the reference company is Acme Energy PLC, and that is the public listed company I mentioned that, and that is a oil and gas company. So here are the values and why each one matters is for those kind of stuff in parameters, value, notes, etc. So from cell 8, which is annual revenue, as I mentioned, the 2500, and that is revenue in the pound million. So the base revenue figure used to calculate carbon cost as a revenue percentage in C12 column, which is here. So how it's look like for those kind of carbon cost percentage revenue, and revenue at risk from demand reductions in C28, which is which is will be available in the CVAR calculator sheets that I will explain on other types. So now we will see the EBITDA. We already seen in the slide that I have given example of the transition scenario as well as the physical scenario. Then total assets we have, which is I mentioned the total balance sheet of that used to calculate a stranded asset ratio as a percentage of total assets, and the investors and lender facing materiality metric. Then market cap used to express a transition CVAR as a percentage of market cap in the CVAR sheet. So the equity investors metric showing how much enterprise value at risk. Then WACC, so weighted average cost of capital, that used as a discount rate, not directly used in this simplified model, but would be used in full net present value based CVAR calculations. So that is the things. And for the technical metrics of scope 1, scope 2, and scope 3, that is covers direct operational emissions added to the scope 2 to the give total carbon liability for carbon cost calculations for the scope 1 emissions. And then scope 2, which is energy related indirect emissions. Together scope 1 gives 850 tons of CO2 equivalent. If you total this kind of stuff, it will be comes around 850, and that the basis for the carbon cost exposures. Scope 3, which is value chain emissions, is not used in this version of the carbon cost model, as companies only pay carbon cost on scope 1 plus 2 in the most carbon pricing regime. So but disclose as context, and scope 3 is also very much important for the reduction strategy, so that is why it's very much important to mention that. Then it comes the high carbon asset share, which is the fraction of total asset in high carbon activities that used to compute high carbon asset value, and represent how much of the balance sheet of standard asset risk under the transition scenario. So these are the fractions total asset in carbon intensity activity. Then it comes the analysis per year, uh, which is primary physical risk, geographic is just a location. So and then it comes to the analysis, the target year for the scenario analysis used to compute year to target, which drives the standing timeline calculations. So here I mentioned the 2035, where analysis target year should be look like in very much nearby or medium type. And the base years, the data we are using the simple but important, the how it's what kind of data that we are going to use. It anchors all time dependent calculations as well. So current year for the baselines, I mentioned the 2024. We will use that 2024 data because the data collections process is very much rigorous and time consuming. So you can utilize the AI definitely, and you can join my Cloud Code course if you want for ESG reporting and the climate risk assessment, where I explained the detailed workflows for how you can utilize the AI to use your day-to-day life time-consuming work. Now then, move into the section B, which is these six cells are all calculated automatically from the inputs above of the sections A, and which is very important to understand. So they are derived baseline metrics that flow into every other sheets that we are going to see. So now here is the cell 23, which is EBITDA. Have the formula of C8 and C9. Basically, it's a revenue multiplications by the EBITDA margin, which is 2500 multiplications by the 22 percentage, which is EBITDA margin, and it comes up the value of 550. So this is referenced by the CVAR calculator to express the carbon cost as a fractions of operating profit. So the metric boards and the CFOs tracks most closely that how the EBITDA look like when we multiplications of those kind of cost. So a 10% carbon cost divided by the EBITDA ratio is the material drag. Also the 30 percentage plus is potential extension. So this is very important to understand that how it's look like for EBITDA, and it's look like that annual revenue and the EBITDA margin is look like for the 550 overall EBITDA coming up. Then cell 24, which is calculated the scope 1 plus 2, which is very simple, 850. Then cell 25 revenue intensity, which is very important from my perspective, that scope 1 plus 2, that is 850 in multiplications by 1000, because it's needs to calculate it in tons of CO2 formula. And then revenue divided by revenue, which is also needs to be follow the directions of multiplications by 1000, and divided by the C8, which is very important tab, which is annual revenue of the 2500. So that's how the revenue intensity covers, and that's how the finance emissions and the finance connect with the climate risk science and the climate science related stuff with the emissions. And that is why it is very important that where your finance goes into opex, capex, and your capital expenditure. So revenue intensity is very much important to report under the SFDR report to investors, also in your internal strategy as well, that how it's work out. Then in cell 26, it's high carbon asset value, which is total asset include multiplications by the high carbon share. So here in cell 26, which is the result comes 5525 million of pound, and that covers the 8500 into the 65% higher carbon asset share. So that is this is the stock of assets that exposed to the standard asset risk under the transition scenario. It feeds directly into the standard asset risk module in the CVAR calculator. So for example, this Acme Energy PLC company, which is oil and gas based company, they have almost 65% of assets are very carbon intensive activities they are doing because of the oil and gas company. For example, coal, fossil fuels, gas, oil, very much fossil fuels they are using, and that is why it's high carbon asset value, and which is very important to calculate to understand the CVAR further. Then now move into the cell 27 years to target. So as I mentioned, that analysis year minus base year, which is I target 2035, and we have the baseline of 2024. So we have the 11 years to do those kind of stuff. And finally, cell 28, that EBITDA value, which is 550 million, with same kind of reference we have. So EBITDA cross reference this simplified and the simply repeats the C23 cell of revenue into EBITDA margins that make directly accessible in the sections without requiring a long cross sheet reference. So in a large model, you might use indirect formula, which I'm just typing here in indirect. this formula you can utilize. So you can reference those text in large model, and basically it's reference the name range instead of any kind of high uh, other formula based tab that needs to be referenced. So this is the section B related to that derived baseline metrics. Now let's move into the very important sections of the company profile, which is NGFS scenario parameters. So here I used NGFS scenario parameters, and that is a reference. We don't require to edit those kind of stuff because it's parameters that are fixed by the NGFS based on the phase scenario, phase 4 scenario of 2023, and there are so many of other scenarios are there. Also, NGFS is used to update all various types of stuff. So you have to make sure that which scenario that you wanted to add in your Excel sheets, and based on that you can edit definitely. But once you finalize that, you should not edit those kind of cells. So basically, the sections of C, the cells contains the NGFS phase 4 scenario parameters that drive the transition risk calculations, and they are hard-coded reference data, not input by the learner. They represent and current of NGFS central estimate published in 2023. So here parameter and the three types of scenario and where the source we have taken from that. So parameter and value first, which is a carbon price 2035, because we targeted the carbon price target year is 2035. So the carbon price trajectory under an ordinarily, that is early coordinated transitions things. So NGFS phase 4 central estimate that around $150 per tons of CO2 equivalent by 2035. So this represent a strong but manageable signal to the business. Then disorderly, we will have the 275 tons of CO2 equivalent dollar, and in hothouse world there will be the $20 of carbon price by 2035. So hothouse world looks safe in the near term on the transitions matrix, but it is very much important to understand what will be the physical risk for that. Then it comes into the standard asset haircut in orderly, which is a 45%. I'm talking about this 37 cell, and minimal carbon pricing reflects minimal policy ambitions. So companies face almost no transitions cost in the hothouse world. Similarly, if you see that standard asset haircut in ordinarily 45%, so the fractions of high carbon asset value written down under an ordinarily 1.5-degree pathway, that is very much important to understand how the percentage can be defined. So highest under ordinarily because the aggressive policy transitions makes fossil fuel asset least economical viable, as we already calculated the high carbon asset values. And that is very much important to see the reference source through the IEA net zero emission analysis. This is the IEA scenario as well, and also the carbon tracker of overall world. Then it comes disorderly, which is 35%, slightly lower than the orderly, because the delay start means that less cumulative standing by 2035, even though the eventual write down may be larger in absolute terms after 2035. So overall transition risk might be reduced, but it will be again more value of your financial perspective through the other risk of physicals. Then in hothouse world, which is 8%, there is a no policy ambitions going on. So very low standing under the hothouse world where policy failures, and that means high carbon asset remain economical viable, where coal power plant, fossil fuels, oil, gas and companies are economical viable in the various types of locations and in the near term. So the trade-off is very much important. So the trade-offs of catastrophic physical risk accumulating over the decades for that kind of assets, and overall financial loss is very much important for them. Then it comes onto the abatement target things. So here abatement target factor, which is in ordinary scenario, which is 30%, and expected reduction in scope 1 plus 2, that is emissions by the target year through energy efficiency, fuel switching, CCS, or carbon capture systems, and renewables. That kind of stuff can be part of that ordinarily. And under ordinarily, companies have policies certainly to invest early and achieve 30% reductions. So basically, it's abatement factors that can be reductions part of the adaptations of various types of projects related to that energy efficiency convert through the oil and gas and fossil fuels. In disorderly, the abatement target percentage is 50%, which is less abatement because policy uncertainty under this orderly discourages early investment, and they don't give any incentives or any encouragement to invest in the energy efficiency or renewable energy cost. And companies wait for clear signals, so something like omnibus regulations. It's took a long time to understand what kind of companies need to be report under the CSRD and the ESRS. So those kind of stuff is there, and companies have certainty, uncertainty for that kind of stuff, and then they face higher carbon cost on larger emissions base, right? And then for the hothouse world, which is abatement factor is 5%. So minimal abatement under the hothouse world because there is a little policy pressures to invest in emissions reductions, and companies maintain status questions operations as well. So now we are on the company profile sheets. Already we have seen all the stuffs that how it's reference to all this things, and this all the datas are going to reference to the next sheet as well. So let's start with the CVAR calculations and how it's look like for the CVAR calculator. So here for this CVAR calculator sheet, which is a climate value at risk sheet, module A, module B, module C. So we are going to see the module look like, and the three blue inputs are going into the parameters. So module A basically carbon cost exposure that calculates annual direct cost of carbon pricing on scope 1 plus 2 emissions under the each NGFS scenario. So this carbon cost exposure is related to the scope 1 plus 2 emissions under the scenarios. Module B, which is a standard asset risk. So we have the various parameters into the company's profile. So the write down of high carbon asset value as a transitions policy that makes them economical unviable, and that will calculate the standard asset at risk. Module C will be the transitions CVAR summary and aggregate of all transition risk components, and the headline number for board and investors disclosures. That these are the stuff that we have to see here. You can see that kind of stuff in various scenarios. That is very important for the transition risk scenario to calculate and to understand the CVAR. So let's go module by module. So in module A, carbon cost exposures from 5 to 13 row, and three blue inputs rows that are 6 to 8, which is feed for formula rows. So which is you can add, and you have to follow the color coding as as well. Sorry. So the logic of chain is carbon price adjusted for abatement, and then convert to the million pound and express as a percentage revenue and the EBITDA. So these are the overall chain for the module A. Here the blue input cell, that is rows from 6, 7, 8. First row 6 is the carbon price, which is tons of CO2 equivalent from various scenario 150 to 75, 20 for ordinary, disorderly, hothouse respectively. Row 7 is GBP slash USD, and you can also update the exchange rate as well, which is 1.27 for all the scenarios. And I mentioned because all the scenarios are all the carbon pricing are maintained in the dollar, and that is why I just wanted to update, because I just added the million, so that is why I just added the converter rate based on your country, based on your jurisdictions. You can add the converter rate through the dollar. Row 8 is abatement factor, which is 30%, 50%, 5% expected emissions reductions by 2035. So abatement factor is expected emissions reductions target year, and by 2035, in orderly scenario, we will have the 30% reductions of emission. Now it's from 9 to 13 is formula based calculated things. So in cell 9 also C, D, and E is calculated 850. So cross sheet reference that pulls the total scope 1 plus 2 emissions, as I shown earlier. Cell 10, which is remaining emissions tons of CO2. So remaining emission is equal to the base emissions multiplications by the one minus the abatement factors that comes under the various types of emissions. So that is the remaining emissions. So we are targeting the 30% emissions reductions by the target year, and the remaining emission is still we need to reduce. Similarly for the other scenario as well. For the cell 11, which is result is 70.3, that formula annual carbon cost. So remaining emissions multiplications by the carbon price divided by the fixed rate, and that will unpack this step. That is very much important to understand that how annual carbon cost look like. So basically it's calculated the carbon price multiplication by the exchange rate. You can definitely divide it by your uh, exchange rate and the multiplication as well. And what will be the annual carbon cost if we wanted to reduce the remaining emission as well? So that is the cost that we need to make sure that needs to be done for year by year. And for other scenario, it's look like more cost, and it's look like the more investments for the physical damaged asset value. Then carbon cost as a percentage revenue. The formula 12, which is carbon cost percentage revenue, annual carbon cost divided by revenue, which is comes under the 2.8. So this cross sheet formula divides the carbon cost C11 by the company profile sheet, which is C8. So that is the C8 annual revenue. And it comes 2.8 percentage. So carbon cost as a percentage revenue is mentioned the 2.8, and in the disorderly, which is 6.3, and the hothouse, which is a 0.5% of materiality check. I will also share the detail of this whole things that I explain in guidance as well, so that you can also read whenever you want through this video. And then cell 13, which is carbon cost percentage EBITDA, which is also very much important to understand that how it's look like. And finally, it's calculated the carbon cost as a percentage EBITDA, which is annual carbon cost divided by the EBITDA, and this formula needs to be done through more operationally relevant denominator, that revenue, because it measures what the company actually earns before financing, and under disorderly it is 28.4, and in orderly scenario it's 12.8 percentage, and 28, this means 28.4 in disorderly scenario of operating profit is consumed by carbon cost under a disorderly transitions, and that level capital allocations or dividend sustainability and the credit ratings are all going to be impacted. So that is very much important to understand from financial perspective. If you don't have any financial background, just try to understand my language, whatever that I explain, and you can also go through the video whenever you have any doubt. So module B, let's move into that standard asset risk. calculation. So standard asset risk quantified the write down of high carbon balance sheets assets as transitions policy makes them economical unviable, and it answer how much of our asset base would become worthless. So from row 17, 18, that can be the included for standard asset haircut percentage 45, 35, 8% for orderly, disorderly, outhouse. Row 18, which is a standing timeline years 10, 8 for 25. How many years of which write down materialized for that kind of stuff, which is input cells in all the blue column. Then with the formula from 19 to 22, for high carbon asset value from company profile C26, all three scenarios column pool that the same, which is 5 double 5 25 on the same side. For the standard asset risk things is multiplications by the 20 45%, 35% and the 8%, and based on that standard asset risk has been calculated. Then annualized trending loss. So annualized trending loss, that total standard asset risk standing timeline divided by standing timeline. So which is very much important to understand that standard asset risk divided by standing timeline, which comes the annual standing loss for any kind of scenario analysis. Standing as a percentage total assets. So here you can see the percentage of the total asset, that how much percentage standard asset risk is there. So this is the investors and lender facing metrics, and how much of the total balance sheet is at risk. 29%, 29.3% write down risk represent severe balance sheet impairment, and this trigger to almost trigger to convent review or rating downgrade analysis under the hothouse, and those under the orderly and under the hothouse, only the 5.2% that seemingly safer, but the trade-off of the catastrophic physical damage risk is much more higher than this transition risk. So here you have to understand that when you are calculating the transition risk, you will see that hothouse world is very much giving a good amount of percentage return in terms of financial aspect. But when you are going to be do physical risk assessment and then calculated the composite risk, it you will understand that how it's look like the overall scenario. So only the transition risk of the policies ambitions and policies implementations is not the right thing to calculate it and then do your strategy, but you have to understand that how transitions is very much important in the climate risk assessment. So module C, now let's move into the transition CVAR summary. Module C aggregates all transition risk component into the total transition CVAR figure. So this is the disclosure ready headline metrics for TCFD, SSB, investor reporting, everything. And from cell 26 to 31 is cell 26 to 31 is formula based things, annual carbon cost, annualized standing loss, also the revenue risk from demand reduction. So here the revenue risk from demand reductions is look like uh, this represent the revenue loss from customers shifting away from fossil fuels as the energy transition accelerate. So under the disorderly, there is mentioned the 750 million, and under the hot house, it will be the 125 million. So here, these are the loss for the company if customers are going to transit from the traditional fossil fuels to the energy renewable energy fuels, then the company will be your revenue at risk in terms of pound of million, this in this that manner. So under the hothouse world, it is 125 million minimal demand reductions because the transition does not happen, and the demand reductions factor, which is 25%, 35%, 30%, and the 5%. So that is why are hard coded as a multiplier of the revenue formula. In practice, you would derive this from IEA demand scenario for your specific sectors, that how it's look like. So it is not necessary to do those energy related stuff, but when it comes to the energy related stuff, you can also utilize the IEA scenario. Cell 29, which is very important, total transition scenario. So here annual carbon cost plus annual standing loss plus revenue at risk, and it comes into the 943.9 into the ordinary scenario, and under the this is the aggregate annualized financial exposure to the transition risk under the ordinary scenarios, and under the disorderly scenario, it will be comes on the 1148.2, and in the hothouse scenario, there will be the no policy ambitions, there will be the no ambitions of implementation or transitions of the policy. So under the hothouse, it will be the 155.4 millions of total transitions climate value at risk. So the result is, which is a 37.8% transition CVAR at percentage revenue. So transition CVAR percentage revenue can be calculated through the total CVAR divided by the revenue, which is comes 37%. And under disorderly it comes 45.9 percentage, and this metric is used in TCFD strategic pillar and also in ISSP and also in CSRD. So it answers what fractions of annual revenue is at risk from the transitions under each scenario. So a number about 30% is typically considering highly material and would be flagged in sustainability reports. So you just try to understand, this is the Acme energy company, and they are a highly carbon assets exposed standard asset company, and that is why this ordinary scenarios comes more and affected things, and that is why this kind of transitions value at risk 37.8 percentage is there. So that is why they have to implement the climate related renewable energy related stuff, otherwise it will be very difficult in ordinary disorderly scenario. So those kind of stuff is very much important, and in these ordinary scenarios, if they are not influenced to the government, that we will require having lots of regulations for the transitions and for the climate change, then it will be difficult for them as well. And finally, the transition CVAR as a market cap. So it will be the total CVAR divided by the market cap, and that comes 15.2 percentage. Under the disorderly it will comes on 18.5, and so this is the equity investor matrix, how much enterprise value is at risk from the transitions, that expressed as fractions of current market capitalization. So institutional investor use this to assess how much of share price might be eroded by unpriced climate risk. So investors facing metrics is very much important. So ordinarily scenario, you already know there will be the policy transitions is coming up. In disorderly scenario, the same things is going on most probably 18.5 percentage, and in hot house world there will be the more climate change and warming and trade-off between the physical and other stuff, and then investor facing metrics is coming up for those kind of stuff. So I hope you understand the CVAR understanding. And now let's move into the sheet 4, which is physical risk things. And as I already explained in the slide of the overall example of Mumbai Coastal Logistic Hub, I will explain in much more details here. So this sheet models physical climate risk using annualized expected loss methodology, and the standard approach used by the catastrophe modelers and insurers and the physical risk platforms like Climata or Oasis. So the model takes coastal logistic hub in Mumbai, which is 120 million asset value, and calculates how much is expected to be lost each year from flooding, both at baseline and under warming scenario. So here the uh, overall calculations is through the annual probability, where asset loss, business interruptions loss, insurance coverage, and sum of across all return periods events from 1 in 10 years to 1 in 50 for 500 years. So here let's start with the asset replacement value, which is 120 million, and the full replacement cost of the asset. This is the exposure component of the HEV framework that I am explained in the slide. So all damage calculation multiply damage ratio against this figure. Then C8, which is business interruptions revenue per day, which is revenue lost per day the facility cannot operate. So this is the separate physical risk component, lost revenue on top of the physical damage, and it requires an estimate of how many days each returns periods flood disrupts operations. Then C9, which is insurance coverage, that 75% of coverage, for example. So the fraction of loss covered by insurance. So net on insurance loss will be the total loss multiplications by or minus 75 percentage of insurance cover. So it comes 25%. We have to look at into as physical risk increase under high warming scenarios. Insurer may withdraw coverage, and this percentage should be reduced in severe scenarios as well. So now let's go into the climate hazard multiplier, that is the adjustable, and this multiplier quantified how climate change amplifies flood hazards under each warming scenarios, and they are calibrated from IPCC AR6 projections from South Asian coastal region and are adjustable as well. So here the flood frequency multiplier, that is SSP1 to 2.6, SSP2 to 4.5, SSP5 to 8.5. So what it means, so flood occurs for scenarios in 1.4 multiplications by as often versus baseline. So a current 1 in 100 year event becomes effectively as 1 in 71 years event. So that is the SSP 1 to 2.6. Then SSP2 to 4.5, which is 1.8 frequency. So a current 1 in 100 year flood becomes a 1 in 56 year event, and that is significant uplift. And the final two scenarios is 2.8 frequency. A current 1 in 100 year flood effectively becomes 1 in 36 years event, and 45, 4.5, which is a current 1 in 100 year event becomes 1 in 22 years event, which is severe and economical disruptive. And when 2 to 4.5, that comes into this, when flood occur, they are 25 percentage deeper than baseline event of the same return period. This is shift all events up the depth damage curve, significantly increase damage ratios, etc. And similarly for the last scenario, 5 to 8.5. So here return period EEL table is very much important, and let's start with that, understand that how it's look like. So each row represent one flood return period event. The table walks across 6 events, 1 in 10 years through 1 in 500. Let's trace through one row in full. The 1 in 100 year event, that is row 22, which is very important, and which is very much understanding that how annual probability is look like. So row and 22 is annual probabilities of 1%, and for that F19, I'm just showing the formula. So flood death, damage ratio, asset loss. So here the formula of C17 multiplications by the E19. So asset replacement value multiplication by damage ratio. So C7, which is absolute reference to the asset values, it cannot be changed, and E19 is the damage ratio for this flood depth, and 12% for the zero point 0.2 meters of the flood depth. So 120 multiplication by 12%, and it will comes to the 14.4 million of pound. So this signs make this an absolute reference when the formula copy down for those kind of stuff, and which is very much important that always point out those kind of dollar signs whenever you don't require to change anything. Then for the G19, which is comes the business interruption loss, daily revenue loss multiplication by the disruption days. So here you can see the C8 multiplications by the disruptions date, that is the five baseline things we have mentioned. So disruptions date, C8 is the daily revenue of 1.5 million absolute reference. So the phi is the number of disruption days that hard coded for the zero point 0.2 meter flood. For deeper floods this increases, and 5 days for zero point 0.2, 12 days for zero point 0.5, 30 days for 1 meter, and 60 days for 1.8, and 90 days for 2.5. You can definitely mention based on your regions and other stuff. So it will comes on the 7.5 meter of business loss overall. Then H19, that covers the overall uninsured loss, which is comes typical formula of uninsured loss of 25%. So asset loss plus business interruptions multiplications by the insurance minus by insurance coverage, and also it covers how much insurance not covered. So the expression applies the inverse of inverse insurance coverage. So if insurance covers 75%, then 25% is uninsured, and the 9 C9 is an absolute reference to the insurance coverage cell, so all the row use the same rate. And critically, the 9 cell of row, which is 75 percentage, means you can change the insurance coverage once and all 6 row updates. Then in I19, which is a yield component and a annual probability of and insurance loss, which is very much important. So here this is what the 1 in 10 year flood contributes to the overall annual expected loss. Although this flood depth is relatively shallow, zero point 0.2 meter, it occurs frequently 10% per year, so its annual contribution is significant. So you have to understand this annual expected loss formula, that how it's look like through the insurance point of view. Now you can definitely go through the various other return period by yourself, and you can go calculated the AEL components as well. Now let's move into the AEL summary sheet, which is very much important for any kind of disclosures or for the boards as well. So AEL summary sheet, which is covers baseline SSP of scenarios, and it covers C, D, and E related stuff, that how its baseline look like and calculated the formula. So here the total base AL that is comes the multiplications of C28, C14, and C15. So all the baseline that needs to be considered, and similarly all the other stuff needs to be things. So total base AEL will be the script. So now we have the physical risk sheet, and this is where we get into the mechanism of physical risk quantification. So the methodology here is very much important of how to calculate the AEL, and you can look at the multiplications of D28 of 2.5, that 2.5 meter times means million times means frequency multiplier, 1.8 times depth multipliers 1.25 equals, and 5.60 million per year. So I'm just sharing this data, and you can definitely go through the various cells. And cell E28, which is 5.7, takes SSP 5.8.5 even further. So by 2100 under the SSP 5 to 8.5, the multiplier are 4.5 times frequency and 2 times depth, giving a combined 9 multiplier as a annual expected loss. So that's 18.9 percentage of annual expected loss of the asset value to the flooding every single year, and on average no issuer will cover that cost, no lender will finance it, and that asset becomes stranded not by transition risk but by the sea flood and the climate risk physical events. So this is the trade-off of the physical risk and the transition risk annual expected loss calculator. Now let's move into the portfolio risk, which is holdings portfolio. So the portfolio risk sheet scales from single company to portfolio level analysis. So that also the models 8 holding across the different sectors that I have just given the example for your perspective, and aggregate their weighted CVAR and the weighted average carbon intensity and flag material risk concentrations and drive automatic bar chart for the same stuff. So here I just quickly explain the input columns from column D to column G, which is weight, CVAR, WACI, physical scores, etc. For formula column will cover H to K, which is weighted CVAR, weighted WACI, CVAR flex, and physical flex. So it will be automatic calculated, and as I already mentioned that it which is very much calculated and available, that formula very much important for you. So now you understand that how it's look like for any kind of sector. So if you are working in financial institution or having a more portfolio, you have more assets, you have definitely you can apart from company you can list it down your assets and list it down the locations, and you can calculate it the weighted CVAR and WACI physical scores and other stuffs. Physical scores you can definitely give based on your requirements, and that is very much important to calculate it, the high CVAR, low CVARs, and why it is things. I will share the learner guidance as well. So this is the sheet where the portfolio climate risk metric summaries also look like this, and portfolio CVAR, which is very much important for to disclosures as well as for your strategy. And here the column J, which is very much important to understand the scenario of the CVAR flag, and the chart at bottom of the sheet is very much important. And basically in the summary table, cell F22, which is 70.9 percentage, is particularly interesting. So that's the concentrations risk formula. It uses Excel's large functions to understand to top three contributor to the portfolio CVAR, sums them and divides by the total. And it's showing the result 70.9%. So over 70% of portfolio total climate risk is in just 3 holdings. So if you are trying to manage this portfolio climate risk, you have 3 highly targeted conversations to have. And this chart for the CVAR holdings at the bottom of the sheets, the bar chart updates automatically as you change the blue input cells above. And if you change HSBC CVAR plec from 20 to 210 to 300, for example, the chart adjusts immediately, and the weighted CVAR in H10, which will be calculated here for HSBC, is also going to be changed. So it is very much important. For example, if I'm calculate 33, it's changing the HSBC finance here is 200. Let's calculate it, and now it's the different. So the chart adjusts immediately, and definitely it can be dynamically as well. If it is not changed, definitely you can also change. So this is the power of building a properly reference model, and one change that propagate everywhere. And the portfolio WACI of 118.7 in F19, which is here, is also very important, and this Paris aligned benchmark is below 100. So this portfolio is above the thresholds and driven primarily by Royal Shell, So at 425 and national grid at 205. So if you wanted to bring the portfolio of weighted average carbon intensity below 100, you would need to either reduce the weights on those two holdings, which is Royal Cells Energy and also the national grid. So ultimately it will comes under the 100, and you would need to either reduce the weights on those two holdings or find lower WACI replacement. So the model lets you explore exactly those trade-offs by the changing the blue cells, and it is very much important. And finally, the last part, this is the tool directory I will share in the Word document. uh, the tool directory is a reference sheet with no formula, that is list of 25 open sourced and low cost climate risk tools, including my tools as well, across the five categories: physical risk, transition risk, scenario data and modeling, and disclosure and reporting tools, and also the build the world AI marketplace tools. For each tools it shows name, developer, platform, language, whether it's showing or not, and you can utilize those kind of tools. So which is very much important, and these are the stuff which is very much cheap price, through the starting from the 3 to 50 pounds, and you can definitely utilize those kind of tools from the website. So the final sheet is the tool directory, and that also will be available in your learner guidance, and formula quick reference you can definitely see in my video only. So thank you very much for paying this attentions, and if you want this spreadsheet, uh, you have to DM me, and it's a paid spreadsheet. I just shared this for this particular model. You have to develop by yourself. Few of the part of this sheet and the formula I will share with you, so that you can also develop by your companies and other stuff, since it's very much corporate level examples that are mentioned. So you have to develop by yourself, and you have to share with me that how you worked for your particular organization's products and other stuff. I will happy to explain that, and after the whole course modules we will have the one-to-one discussions on that. And also if you have any kind of doubts, also we have discussions peer-to-peer learning as well, so we will catch up on that side. So yeah, thank you very much, and we will continue our presentations from that. So this is the final sections of module 6.3. I hope you have gone through the Excel modeling and financial impact assessment. If you have any doubt, feel free to connect with me. So the theory and methodology only matters if you can actually do the analysis. So this sections gives you more tools and platforms where you can most of the use those kind of stuff. If you have any doubts on that, feel free to connect with me. Let me highlight the most important open source tools grouped by use cases for physical risk. That is, I already mentioned during our explanations that Climata from ETS Zurich is the gold standard open source physical risk modeling framework. So it's a Python based, which is heavy to understand if you don't have the backgrounds on that, and has a global coverage of 4 kilometer resolutions and cover tropical cyclones, river floods, drought, and wildfire, and also the EOPA is also released new version of Climate app in June 2026. So that's a user interface for people who don't code. So you don't need to write Python to run basic assessment. So this is what I would recommend as your starting point of physical risk. For transition risk and portfolio alignment, PACTA from the Rocky Mountain Institute is free for banks and asset managers, aligns portfolio to IEA net zero APS and steps scenarios, and covers the 6 highest emitting sectors. Also the OS climate from the Linux Foundation's aggregate NGFS physical hazards and the corporate disclosure data through open APIs. So for scenario data, the NGFS Scenario Explorer at ngfs.net is the official source for NGFS scenarios parameter, including the CMIP 7. The now SSP database has the full IPCC ER6 datasets, and the Copernicus climate data store provides a free satellite derived climate data with a Python API. So this is what fits the hazard module in Climata, and 5 PSA is worth mentioning, specifically if you work with energy sector transition. It's open source system optimization model used by research and governments to model carbon pricing impact on energy assets and standard assets timeline. So all the tools are in the Word documents I will share with you with the descriptions and access guide. The BTW AI marketplace, where we offered more than different tools. I have not listed out all the tools, but definitely if you are wanted to explore, feel free to message me and you can directly buy on the websites. So meaning they are designed for the real world use and not academic exercise. So flagship tools for this module is the company level climate scenario analysis. So dashboard at £10, definitely you can explore it, model physical and transitions risk under the NGFS and IPCC SSP scenario from 1.5 degree to 4 degrees Celsius and produce a financial impact projections under the multiple pathway and generate the TCFD aligned scenario narrative with interactive board level chart. It's built in Power BI and Excels and also through the AI, and it's work immediately without any special software. So it's things is there. Also the future energy demand, also the advanced GHG emissions calculator and other tools are available on the website. You can explore that things. Just wanted to explain the company level scenario that I also published. You can utilize this link. I will share in the email. You can walking through the video and then you can buy the tools that require. So the post attracted significant engagement from the climate finance professional. They use these tools very frequently and they are we have a good feedback on that side. And this is available on the websites, and if you want to replicate any analysis for your own organization, feel free to connect with me and or any kind of stuff. So if you want to build the methodology in this module using various types of tools through the Excel workbook from these modules and also the free toolkit if you require uh, uh, for your company, I am happy to build for that as well. So you have everything you need to conduct a credible company level climate scenarios right now, and you can use those kind of company level climate scenario analysis tool. For video, definitely you should go on my LinkedIn as well as on my Instagram, so you will understand what kind of climate scenario company level tool that we have built. So let me close with the 5 things I want you to remember from module 6. One, that is CVAR equal hazard times exposure times vulnerability presented value. So this formula connects physical climate science directly to the financial impact. Learn it and you can explain climate risk in language that CFO understand and boards understand. Second, the disorderly scenario creates the highest transition risk, not the most ambitious one. Delayed policy followed by the appropriate actions produce the biggest EBITDA shock and standard asset crystallization. So this is the scenario financial supervisor fear the most. Then third one, which is annualized expected loss, converts the probabilistic hazard data into the stable annual financial metrics. And under the SSP 5 to 8.5 by 2050, typically coastal asset AEL can be the 2 to 3 times of the current baseline, and that's a material drag on asset value that balance sheets don't yet reflect. And the fourth one, which is WACI and physical risk scores, are the two portfolio level metrics most immediately extendable for investors. WACI above 100 flags that transition risk, physical scores above 60 flags material physical hazard exposures. And the fifth one, which is you don't need to expensive proprietary data to do those analysis. Use our tool, very cheap, but again if you want more dynamics, you can contact me. We can have features ready for the various corporates we are providing, and you can use that tools as well. And that is a build credible disclosure ready climate risk quantifications for fractions, and you can use the open source institutional tool as well. So thank you for completing this module, and I will see you in module 7 where we take this metrics into the climate aligned portfolio constructions and the net zero transition planning, because it's very important to reduce the emissions and adopt climate resilience stuff. So thank you very much.